When did the Dow, I'm just curious, when did the Dow lose its relevance?
Sometime in our lifetime, because you and I are the only two in the office that even talk about the Dow.
If you ask Lee Mackey, that's a date well into the future.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Welcome to the Market Moment. This is Matt here with Lee.
Good morning.
And John.
Good morning.
Okay. Please use your normal voice the rest of the podcast. Hope you guys are doing well. Excited. Got a couple good topics for conversation today. We'll see where that goes. Anything you want to start with before we just jump in?
No, it's hot.
It's hot.
For those listeners and viewers.
Hey, the most favorite sport in the world is getting ready to start. It's World Cup Challenge. Yes, Americans don't know much about it, but World Cup soccer
starts in 2 weeks.
I know,
week and a half.
And it's a lot of fun. I encourage you to watch it.
No one's going to be at the games because they can't afford the tickets.
Well,
man, the tickets are silly.
Closest is Dallas to us, correct?
Is it?
Yeah. This is way off the topic. You brought it up.
It was a train wreck as soon as I started.
Have you seen how they bring in all this grass for these indoor stadiums, and then they put those orange, pink lights on it to rapidly grow it? And
crazy.
Kind of cool.
It's kind of cool. A lot of money spent on the World Cup.
I thought this was a really good conversation to have, because we come across it, have this conversation with clients, prospective clients all the time. But it's, looking beyond the S&P 500, choosing the right investment benchmarks for your personal goals and portfolio. I think this is really good. One, let me preface this. When I say, when we say looking beyond the S&P 500, that's not to say like, hey, don't buy the S&P 500, don't invest in that way. It's just, from a benchmarking perspective, a lot of people, it's easy to just apply, well, what's the most common kind of metric or benchmark for the United States stock market, which is the S&P 500. And so just and apply that as the benchmark towards whatever you're doing in your own personal portfolio and situation. And that can be really, really, I don't know, dangerous is maybe extreme, but this is
unfair.
This is a podcast and YouTube, so we like to be,
it can
extreme.
be unfair. It's not true.
100%. And so you have to be really careful of just saying, hey, well, this benchmark did this, why am I different?
Right.
And making sure you have the right benchmark to your situation. So, Lee, what are your thoughts on why that is so important and what people should consider when they're trying to find the right benchmark to know, are they doing well relative to how they should be doing?
Well, because most people do not have their money only invested in large cap growth, which the S&P 500 is an index for. You mentioned the word fair. I think it's, the S&P is so widely used. It is, it is the king of all benchmarks, if you will. It's I don't even know, it's not the broadest, but it is a popular one. And I think it really comes down to the fact that, most people are not invested in one single type of investment, large cap growth. And so to compare your diversified portfolio 60-40, 50-50, even if you are 100% equity, if you've got value in there, if you've got small cap in there, that is the S&P 500 is not the most appropriate benchmark to judge your investments by.
But why is that noted? But why is that important? Like, why is it important to have the appropriate benchmark?
Well, your expectations are, and we get this a lot when clients come in and say, hey, my portfolio made X and the S&P made more, why am I not keeping up the S&P? Everybody at work says that their 401ks are, beating the S&P, blah, blah, blah. I always think this is interesting because, I'm going to make this broader than what we're talking about right now.
Go for it.
Couple things. Most people in the U.S. or our clients or whatever that are working use 401ks or some sort of retirement vehicle where they're dollar cost averaging in, right? They're buying shares every paycheck of something. And even if you're buying shares of the S&P 500, even if the only thing you're buying is the S&P 500, that is an unfair comparison to look back a year and say the S&P made 10 and my portfolio only made 9 or my portfolio made 11, because when you're dollar cost averaging in, you are not in the same comparison. Each time you buy, it creates a new year starting point, right?
Yeah.
So that's one. But most importantly, you have small cap stocks, which are not in the S&P 500. You have international stocks, which are not in the S&P 500. You have emerging markets. You have fixed income. You know, like a lot of people think the standard benchmark is a 60-40, portfolio. Everybody, that's a moderate portfolio, and that's kind of like the standard. But 40% of that is fixed income. To have a proper benchmark comparison, you would want to have 60% of your portfolio compared to the S&P, 40% compared to the Bloomberg U.S. Aggregate Bond Index.
Right.
So I think the mistake is that you hear coworkers or you watch the TV or whatever, and everything is compared to the S&P, and that's why I said in the beginning, unfair, because the S&P is one of many styles and specific benchmarks, and it's rarely, to your point, Lee, are you only in the S&P 500.
Yeah.
Most of the time you are not.
Yeah.
So,
Well, so
anyway.
so my thoughts, thanks for asking,
Matt, what are your thoughts?
There's two main drivers of the market. That's good. I maybe y'all should ask questions, because I feel left out from time to time. But
I know that's true. We don't ask you questions.
Two main drivers in the market: fear and greed. Right.
Sure. 100%. Yeah.
And so, I would say why it's so important to have the appropriate benchmark and set the right expectations for yourself and your portfolio is you have to have a portfolio that you can stick with, both on the upside and the downside. And if you're applying the wrong benchmark to your portfolio, it's going to be much more difficult to stick with how you're invested. If you're looking at the S&P, you're invested in a 60-40, you're broadly diversified, you have international exposure, and you're set up in a really good way for your maybe, nearing retirement.
Yeah.
But you're constantly looking at the S&P 500 and saying, like, why am I not getting that? It's going to be really hard to stick with your 60-40 because two main drivers of the market, fear and greed. Mm-hmm. That greed is going to start creeping in of, I want more of that. I want more growth. I want more. And so it's going to be harder to control fear and greed, which are already really difficult to control in investing, if your expectations are out of line. And so that's how I would, at a high level, summarize why is it so important to have the right benchmark, is because just you have to have humility when it comes to investing, and just accept the fact that I'm not going to be able to have the discipline necessary to stick to it if I don't have the right expectations for what I should be achieving, because it's already hard enough to stick with the plan and ride through the ups and downs, underperformance, overperformance, and all of that.
Well, especially you can get caught in the comparing like one stock to the S&P. You can be, we talked about this, a couple of different stocks that have just skyrocketed over the year. And if you're watching TV, watching the business channels, and they talk about how great the chip makers are, or this or that, and you're not in it, and you feel the fear of missing out and the greed that you want to be part of that. If it goes back to the concept of planning your portfolio. Unless you're a day trader and you know what you're doing, stop chasing that stuff. It's almost bad to listen. Like, I love listening to these financial shows. I listen to them all the time, get great ideas, whatever. But it is such a if you can't do that full time, it's a fool's errand, right?
When we were building plans, we used to, refer people to what is the minimum required rate of return to achieve the desired outcome. Mm-hmm. So, like, let's collect the data we need. What is the desired outcome? That can be anything, right? It's not just, hey, barely make it and have enough to live in retirement. Maybe it's leave a legacy. Like, you define that.
Yeah.
What is your desired outcome? And then we can reverse engineer, okay, based on the assets you have, the future income, your time horizon, all of these things, what do we need to make at a minimum to make all this happen? Now, we can always invest in a way that maybe we're trying to get a little bit more than that. But when we now have this minimum need, hey, we need 5.2%. And as long as we average 5.2% over the long term, we're going to be in a good spot and we'll be able to make all this happen. If you know that, you're going to invest differently. Most people are going to invest different than if you don't know that and you just think, I need to be invested and make as much as I can. If you know, hey, I'm okay at 5-6%, then so that's step one. Step two is then, okay, have the portfolio that can do that as consistently as possible with maybe as little volatility as possible to achieve your minimum required rate of return or higher, and then find the appropriate benchmark so that you can
gauge,
dictate your performance and how you're tracking and are you doing better or worse than you should be doing relative to an appropriate benchmark.
Yep.
That is kind of the sequence of events for putting together expectations and then having a strategy for being able to stick with it for the long term.
When the market is doing well, like it has since 2009, with a few tiny exceptions, but the market's just flown through different types of presidents, different type of markets, but it's flown for 17 years now. A lot of young people especially have no idea what a bad market is. They've not been through that. And if you do your number, if you find out what your number is, what your required, your least amount of risk required to achieve your goals is, you're most likely taking more risk than that. And I say that just because we do plans all the time, and a lot of times we find that out, right? Because it seems easy.
Yeah.
And the fear of missing out, you want to be part of that. You want, and I hate to use the word greed, but you are trying to keep up with the market.
Greed. And I don't mean it in a bad way.
No,
like
it's not.
People agree. It's just greed. Like if you feel like that could be yours, like why, you have the, I don't know, competitive, I don't know, just you want it, right?
You're right. Go back to 2009. Lee and I are old enough to know this. 2009, people had a completely different attitude than they do now. Completely different. They were happy when they got 5% return because we had just gone through a year and a half of a destruction of the market, right? 54% down, top to bottom. So your questions and answers on their risk and all that stuff were a lot different than they are today because they just went through a painful thing and they didn't want that to continue to happen to them.
Yeah. It's recency bias on both sides.
It's recency bias on both sides. Yeah.
Both when things are going well and when things have not gone well. So, Lee,
my mind's spinning over here. There was a couple of things I was going to ask. One, if a client came in and said, what's the best benchmark? And again, that's not a fair question. But if they were, in your opinion, what is the most, on the equity side, the best benchmark to use? But then the other thing I was thinking about was, I'm taking the cynical side is, well, you can find a benchmark to say whatever you want it to say. Does that make sense?
Yeah, it does.
Now, it's the most appropriate, but you can find the right indices to put in place and make this combined blended benchmark. Anyway, so I was thinking about that as far as if clients come back or people come back and say, well, you can just, the return is X. Well, you can find a benchmark to make your number look good or somebody else's.
Yeah, I mean, you have to, when you apply a benchmark, you have to, I'm not saying you could never adjust or tweak, but you have to stick with it.
Sure.
You can't be constantly changing.
And that was going to be my point is that in good and bad. Yeah.
The benchmark should only change if your investment objectives and allocation have significantly changed.
While y'all were talking, I was curious as to how many indices or indexes are in the U.S. right now. Approximately 5,000 different specific
different ways you could create something.
Yeah. I mean, so it is interesting.
Yeah. And I think if you're someone who's younger, who's earlier on in their investing, life, then, applying the S&P 500 is perfectly acceptable.
Sure.
Right. If you're just buying in your 100% equities in your portfolio, then I think the S&P 500 is a much more appropriate benchmark, and you probably should be using that to look at, well, should I own small cap? Should I just buy the S&P if it continues to outperform? It's just very different when your goals and objectives start 100%. To change, which is a perfect segue into our next conversation.
Nice.
So,
do you
I
crushed
like that segue, by the way?
Do you like the Russell 2000 as a broad benchmark more than the S&P 500? And I know that's.
Do I like the what?
The
Russell 3000?
Yes, I said 2.
Yeah.
The Russell 3.
Yeah.
As a broader, true indicator of what the markets are doing. I'm just curious.
What? Honestly, I don't look at that very often.
Yeah,
I look at now the S&P 1500 sometimes comes into play if you're getting more all cap, more.
Sure.
But
I was just curious.
I'm basically No. Answer your question. No, I'm using all the major S&P 500, Russell 2000, MSCI index most of the time.
Okay.
But that's a good question. Maybe we should look at that sometime.
Yeah, I think I was trying to get logged in here real quick.
You had a great segue, Matt, and then you just
I
kind of
know,
lost it.
Lee just blew it up.
Thanks.
I teed it up perfect.
Talk amongst ourselves, Lee. while he's
No,
getting
so
his segue.
yeah, I think that's a good point. I mean, the S&P is the best benchmark because it has been the best benchmark because it's been the best performer. You know what I mean? Like, so I mean,
Yes,
it's kind of hard to argue against that, but I get your point on if you're looking at, I would say like, look at VTI.
Sure.
Right? Just Vanguard total
Index.
When
did the Dow, I'm just curious, when did the Dow lose its relevance?
Sometime in our lifetime, because you and I are the only two in the office that even talk about the Dow.
If you ask Lee Mackey, that's a date well into the future.
We use the Dow all the way. You know when I think it was like the 2008 financial crisis when the S&P became the big driver.
At some point in our
the
career,
Dow was the big thing.
it lost its relevance.
It did. And the Dow 30 was the 30 biggest, you had to be a
Well, I will tell you this.
mega
This
company.
this podcast is doing everything in our power to bring it back. So
Okay. There you go.
we might be fighting the battle alone, but
gonna-
by golly, we're fighting it.
We might be the only podcast out there that mentions the Dow.
we're gonna write
you
a
get a
song.
lot of clicks for that.
What's crazy?
We're gonna write a song.
So this is-
bring in Dow 30 back.
SB Country.
So this is what I was trying to pull up. So like if you look at the last 10 years, you overlay like the S&P versus the Russell 3000, it's like the charts look almost identical. That's the thing with the cap weighted indexes is you can look at the Russell 3, and that's what I thought. I wanted to look at the chart before I just said it. But as soon as you said that, I was like, I don't think the performance has been all that drastic because the big companies have gotten so stinking big and have been such a part of the growth. So, which is just crazy to think, well, the other 2,500 companies just
Don't matter.
Yeah.
I mean,
Crazy.
It's kind of harsh, but it's true.
yeah.
Okay, so next question.
Okay.
The segue that happened like 7 minutes ago. The psychological impact of shifting from wealth accumulation to the spending stage. So, as we're talking about applying benchmarks, how should I be invested? Am I doing well relative to how I'm invested? That's all great. But along with that, you're often asking yourself that question at the same time you're kind of gearing up for this shift from, hey, I'm in growth mode, accumulate, save, invest, dollar cost average into, hey, I'm actually needing income off of these assets and I'm going to start spending. And there's a huge
mindset
emotional,
shift,
psychological shift that is really, really hard for people, understandably so, to make that happen. So a couple things I wanted to mention here. I'm going to pull up my notes. So if your goals have changed, your portfolio should reflect that. Okay. So if you're getting to retirement, your goals are naturally changing, right? So they have to be kind of by definition. So your portfolio should reflect that in some form or fashion. Defining your clear goals allows for more freedom in your spending. So as you start to get closer to this stage of, hey, I'm not investing as aggressively with new money, I'm maybe not being as aggressive in my portfolio, and I'm going to not need to start taking income out. Knowing what your goals and objectives are, knowing what you need for income, and the more clearly that is defined, gives you freedom in, maybe how you go about accomplishing those things. Making regular updates and adjustments if necessary, and then solving for income, because retirement is an income calculation, solving for income first, and then potentially keeping a portion of your portfolio invested more as you maybe historically had been for long-term growth, allows you to kind of scratch that itch of, having part of your portfolio still at position to do well for long-term growth. Most people need that, but even if you don't, I think there's a psychological component of having a bucket that you're still trying to do that with, just because, again, going back to what I said earlier on having an allocation that you can stick with both on the upside and downside. If you're all at if you can take all of your money out of the growth bucket because you've got a substantial amount of assets, you can produce the income you need in a very conservative portfolio. Some people can do that. a lot of people, it's going to be really hard if you're sitting on the sidelines, even if you know you're okay and you're watching the S&P compound at 12% annually,
Yep.
Moving forward. So giving yourself a bucket to say, hey, we're going to still try to get some of that return with a portion of our assets. So having the plan, clear expectations, clear goals can help with a lot of these psychological shifts that happen when you're transitioning from the accumulation to spending stage. I kind of stole that question because I just rambled for a long time. But what are your thoughts on, the impact or the things that people should consider when they're trying to make that transition? Because it can be really difficult.
Well, going back to the very first thing we talked about, know the least amount of risk possible to achieve your goals. I think that's ultra important when you get to retirement. When you're 30, that's just a number. I don't even know if it's that important. You want to invest, and that's basically what it is. You invest for yourself, invest for your future. When you get to retirement and there's no more income coming in, like you said, it's an emotional, distressing time for you as a person retiring because the income check's not coming in. So it's very important to know that number. And then the other thing you said that I thought was spot on was find a way. Where are your income sources going to come from? Are they coming from pension, Social Security? And what portion of your income is going to come from your investments that you saved all your life for, that you've never had to take from? Now you're going to have to take from them. What amount is that? And can you solve that with income? Can you make that easy?
Having a plan is giving yourself the permission to spend.
Right.
Because if you don't have a plan, so many people who have planned well they're good planners, they're good savers, they're good investors. They've made all the hard decisions.
Yep.
They've probably been the ones that haven't bought all the brand new vehicles, and so they're not used to splurging throughout their life. And then all of a sudden you get to retirement and you're like, wait, I'm supposed to start spending this. If you have a plan and you know what you're quote unquote allowing yourself to spend, what your portfolio can spit off, then you're giving yourself the flexibility. Because if you don't do that, then it's going to be like penny pinching moving forward, because you're going to be afraid. Am I overspending? Am I not? How much am I, how much can I afford to spend on a year-to-year basis? And so, those are the people that end up passing away with a substantial amount of assets, more than they even retired with.
Yep.
And they may not have even had a legacy goal. And that's kind of one thing we talk about is like, hey, use these, these are resources the Lord has given you, like go use them, like give them, help your kids while you're still alive so you can watch them enjoy it and all of these things versus, not having a plan and then just watching your assets continue to grow because, if people have the flexibility, know that they're going to be okay, I think a lot of people would enjoy using those resources.
It's hard to break habits.
Yeah.
I think in very general terms, I think most retirees, pre-retirees, they work. They come in, they want to know how much do I have? I mean, 30s, 40s, 50s, they want to know how much is in my investment account. At some point, that becomes much less important, and it's simply, can I pay my bills?
Yeah. Can
I do the things that I want to do? Whether they've got $2 million or $200,000, they don't care.
Yeah.
They want
how much can I spend?
Unless your goal is I want to leave a legacy.
Yeah.
But most retirees, there is a point where the conversation's not how much do I have.
Yep.
It's strictly do I have enough to do what I want to do. Beyond that, they don't care.
I ask a question when somebody's getting ready to retire. I ask a question always, and it's a funny question, but I always say, do you want to bounce your last check? Meaning, when you die, do you want your last check to bounce? Or you want to spend everything, or do you want to leave a specific amount you want to leave behind? Mm-hmm. And, of course, we don't know when you're going to die, so don't do the bounce your last check thing because you don't know when you're going to die. But the point of that is, do you want to spend and enjoy your life, or is this meant for somebody else? And the overwhelming answer I get for that is they want to bounce the last check, and it's kind of a funny question because they're going to leave stuff behind or they've helped their kids throughout their life or whatever. Yeah. The overwhelming question. But the overwhelming result is we leave a lot to the family because you're again, that spending habit. People that are really smart, save, frugal, do all the right things, don't buy a car every 2 years, which Kathy and I don't fit in that bucket, so I can't say that. But those that are really smart about it, right? It is really hard for them to turn that switch and say, oh, I'm going to go have a good time. I'm going to go travel. I'm going to take a $10,000 cruise. I'm gonna go get the new car and all that stuff. It's so hard. And that what happens is ultimately they've just worked their whole life, saved, done all the right things for their children and their grandchildren, and they don't know how to even spend it.
Yeah.
So I encourage you to find a way to enjoy life, but have that. The numbers are easy. I mean, when you do financial planning, the numbers, we can help you figure that out. It's not hard to bridge the gap. The other thing, I think the one mistake too is that people think, misconceptions, when you hit your RMD age, you don't have to take all your IRAs out. Yeah. So let's get that misconception out. Also, your money has to last the next 30 years if you retire at 60 and you're going to live to 90. So it's not like you go short-term investing. It's not a short-term investment strategy. It's still long-term. It's just the
long-term with income needs.
With income needs and legacy decisions.
Yeah.
That's what it is.
All right. Well, good conversation. We'll wrap it up because we've been going on for a while. Hey, we do have a new rule, though, on the podcast. Neither of you are allowed to clear your throat ever again on the podcast. So just wanted to make that.
Is that as annoying to everybody else out there?
Yeah, I'll answer for the audience, yes. Okay, I do have one question.
Audience.
I do have one question. I love calling you guys out.
I can't help allergies. I can't help it.
One question to end with. We've been doing these fun questions at the end of the podcast. I'm telling you, you should actually watch your own show.
I don't want to see it. That's why I don't watch it.
So I've been having like 5, 6, 7 of these questions. I couldn't think of a bunch of good ones. So I have one super, super important question.
Okay.
Knicks or Spurs?
Ooh, wow.
Who do I want versus who do I think?
Yeah, do that.
No.
Yeah, do that.
I want Spurs. Think Knicks.
Okay. I want Knicks. Think Knicks.
Okay. I'll go Knicks. It's time.
I know. It's time. It's time to bring it back to the
Big Apple.
Madison Square Garden, MSG.
Yeah. So,
Anyways,
it'll be fun. It'll be a fun series. Spurs and Knicks.
Starts tomorrow night.
Does it?
Tomorrow night.
Okay.
And World Cup.
And World
Starts
Cup.
in 10 days.
Yeah. Well, as always, we appreciate you guys watching and listening. As I, from time to time, like to plug, be sure to check out Eli's data brief. I think he had one go out last week, so he does a really good job on that. So check that out. Give us a like, subscribe, or send us any questions or comments. We'd love to see those. We look forward to seeing you guys next week.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com.